Okay, good morning and welcome back to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play, and we just wrapped up one of the strongest months, or the strongest month since the start of the pandemic in November. And we're entering December, and the question on a lot of investors' minds right now is, are we going to see a rally into the end of the year? And those are some of the things that we want to start taking a look at and wrapping our heads around as far as where the equity markets currently sit and what our expectations are going forward. Now, before we get started, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. We'll start off with our broader market update in terms of the major indices. We've seen a bit of a shift here in terms of leadership from the broad-based indices. What we're seeing here, we're going to discuss that. We'll take a look at commodities rates in the different sectors that have largely reacted to some of the rotation that we're starting to see. We're starting to see some of the stronger sectors that were leading this market higher start to fall behind. Some of the sectors that were actually gathering strength, continuing to gather strength. So we want to show you where we see opportunities within the sectors. Looking at housing and economic data, we're starting to see a bit of slowdown in some of the optimism in this data set. So it's important for us to, if we're invested in any of the type of real estate type companies or any REITs or housing type related data, housing related stocks, these are ones that we want to pay attention to, as well as employment. Data is important for us to continue to monitor very closely for the shape of this recovery. I want to talk a little bit about the rising number of COVID cases and the employment data that we're currently taking a look at, because that does have an impact long term, less so on the short term, but much more so on the long term in terms of the shape of the recovery, and then cover some of the ideas that we have here for today. And at the very end, we'll open this up for questions if we have a few minutes. But the primary question that I want to help answer is, should we expect a Santa Claus rally going into the end of the year? So my name is Tony Zhang. I'm the chief strategist here at Options Play. And what I want to share with you are my views, my charts on how I'm currently viewing the broader markets and the major indices and sectors, and the different ideas that I have as a result of all of that. So we're going to start off by looking at the NASDAQ 100 index, the tech-led index that really provided most of the outperformance of equity markets from the March lows all the way through the beginning of September. Now, since September, technology has largely lagged behind the broader markets. When I refer to the broader markets, I'm talking about the S&P 500, the Dow, even small caps lagging behind all of those markets. But over the last couple of days, we've just started to see it start to break out above its trading range, that resistance level. Now, technology shares have not reached an overbought condition. They're short-term slightly overbought, but money flow is starting to turn positive again. So this is starting to show that tech is back in the driver's seat, and this is really one of the sectors that we could start to see some outperformance in the month of December. So as we're looking for further gains in equities in December, as vaccine news continues to come out relatively strong, a lot of optimism around that, because both Pfizer and Moderna have now applied for the emergency vaccination and potentially have a authorization by the third week of December. Equity markets are trading on this optimism. And when we're looking for performance from an equities perspective, tech leadership is certainly one place that we will look. Another place we will look is broad-based indices in the S&P 500, which largely broke out from these all-time highs of that 353, 350, 360 level, and has now broken above that level, came back to retest this as support, and now has, again, opportunities to continue moving higher. Both the money flow started to turn positive again here on the S&P 500 and is not currently overbought just yet. Now, IWM, small caps, this is really where a lot of the outperformance over the month of November came from. Actually, small caps, best month, I think, since the dot-com bubble, if you will, in terms of monthly performance coming from small caps. So small caps drove a lot of the leadership here. We're starting to see that fade a little bit. We're starting to see the big cap indices, the S&P, the NASDAQ 100 starting to regain that leadership again. As you can see, small caps today actually not making all-time highs just yet. So small caps starting to fade a little bit, as you can see. It already reached overbought on the momentum. Money flow was extremely strong. We expect to start to see that fade a little bit. And same thing here with equal weight. The equal weight S&P 500 index actually failing to make new highs and actually opening flat here on the day, while the actual S&P, the market cap weighted index is actually up about 0.8%. So we're starting to see this underperformance of the broader S&P 500 stocks. That has largely reached, in my opinion, a bit of a peak here. And we're going to see some of the mega cap names start to outperform again, looking at Apple, looking at Microsoft, Tesla, these types of names that largely have underperformed here over the past couple of months, starting to come back to life here a little bit. So those are the places that we want to start looking for opportunities. Now, I talked about this over the past couple of weeks, and largely we're still seeing exactly what I was expecting, which is a new normal for the VIX. We were talking about the fact that VIX in the 23-24 post-election levels were relatively low or near all-time lows since the start of the pandemic, but I would argue that now that the election has passed, and now that we have a fairly definitive date as to when the vaccine will likely start distribution, especially if both Pfizer and Moderna are approved for emergency use here in just a few weeks, that shifts the uncertainty that we have in the broader markets back closer to what we had prior to the pandemic. So if you look at prior to the pandemic, the current levels of 20% is actually on the higher end of that range. The lower end of that range are the low teens. So my preference is that volatility is likely going to actually return back to its old normal. So we're going to call it the new normal, but it's really the old normal. So the 20% is actually the higher end of the range, which means that we're still in an environment that favors selling option strategies, selling volatility, selling credit spreads, selling covered calls, selling cash secured puts on stocks that you want to buy. But option selling strategies is still relatively attractive in the current moment, even though volatility is relatively on the low side compared to the past 8 or 9 months, where the uncertainty factor of the markets are just in a whole different world. The one thing that we have continued to see over the past couple of weeks here is the US dollar continuing to break lower here, and actually recently, just last week, started to break below some major support levels here around 92 on the US dollar or the dollar index. You could trade this through the ETF UUP. This is actually one of the short positions that Mike and Carter have from Options Action from a few weeks ago, still continuing to work out. This is one that I expect to see further downside here for the US dollar. This has ramifications for gold. This has ramifications for Bitcoin. A lot of people are looking at Bitcoin right now. That was one of the things that we talked about here last week. But crude I wanted to bring up because the question is right now is whether or not we've reached this peak oil in terms of demand. And largely, for the most part, oil still is holding this $44, $45 resistance level. It is starting to break a little bit higher here, but the OPEC members so far have not come to an agreement in terms of cuts. And the question is whether oil will continue to move lower or continue to move higher here. Right now, the demand for oil continues to look bleak in terms of what we expect the recovery is going to look like. We're having more and more countries around the world adopting fairly aggressive plans to phase out internal combustion engines and move towards electric vehicles. China, the UK, California, this is, in my opinion, just the tip of the iceberg. We're going to likely see far more over the next few, maybe even the next year or so, but certainly over the next 5 years, we're likely going to see some very, very aggressive targets from some countries. And that's going to have a major impact here on the demand for oil. So a lot of investors are already saying that we've seen a peak in demand for oil, that we will never go back to what we originally were consuming, in just a few months ago prior to the pandemic. So XLE oil, in my opinion, not looking particularly strong. When we look at the 10-year yield, 10-year yield still maintains this upside channel here. It is testing this support level. It's been bouncing or testing the support level here for almost a couple of weeks now. The question is whether it can continue moving higher up to the 100 basis points. That is currently still our base case, that the US 10 years will trade within this range and continue to grind its way higher here. But when we look at fixed income investors, high yield continues to be attractive for fixed income investors, meaning fixed income investors are continuing to take on risk. There's a risk appetite. There's a chase for yield, and the only place they're getting any yield right now is high yield. And high yield, from a fixed income perspective, at least if you look at the price action and the flow, fixed income investors do not seem to be too concerned about the risk in this category of the fixed income markets. And they're still continuing to sell treasuries. That's why we see the 10-year yield continue to climb, and they're buying high yield fixed income products like HYG, which provide a little bit more income versus the treasuries. Not as safe, obviously, but income. So investors are saying that they're preferring income versus safety. That is the risk on metric that equity markets also look at and say, okay, fixed income markets are much, much larger. If they're not concerned about risk, we can continue to take on risk here in the equity markets. And that further supports, the rally that we're currently seeing here in equities. Now, if we look at the individual sectors within equities, there's quite a bit of rotation that has happened here. XLF, which has largely underperformed the broader market since pretty much the start off the March lows, as you can see, barely really moving much off of the March lows over the whole time that the S&P 500 has moved substantially off of those March lows, and especially if you look at technology shares. But over the past past month, specifically the last month, as the equity markets were kind of wavering a little bit as COVID cases are starting to rise, we saw this sharp move here in financials. And the question is whether this rally can continue. So far, looking at this, financials continues to see quite a bit of strength here over the past couple of trading sessions. So this is where I believe XLF can continue to move higher here. And this is actually one of the ideas that we have for today. When we look at XLU, an interesting thing here about XLU is that XLU also, just like financials, underperformed for the large part of the broader rally. Since the beginning of October, started to come back to life, actually keeping pace with the broader markets. And this was quite unusual because we were in an environment where interest rates were rising. That, generally speaking, is a headwind for sectors like utilities, but we saw utilities actually rise alongside with rates rising. That gave us quite a bit of confidence that XLU was seeing quite a bit of relative strength here. But over the past couple of days, XLU has started to decrease that relative strength and is actually back in line with the S&P 500. So it's fading fast, and this is really one of the sectors that we had some optimism for, but that is now faded. When we look at XLV, healthcare, we would think that in this type of market environment that healthcare would be doing well. You have some pharmaceutical companies in XLV that would potentially likely become beneficiaries of the COVID vaccine and just the general recovery, but that is not in the case. XLV has only underperformed from March to basically April or mid-April, and then since then has largely underperformed the broader markets. As S&P 500 has rallied 30-40%, the XLV has only rallied 10 to 20%. And over the past couple of weeks, we saw a little bit of outperformance here from XLV, but since then, severe underperformance again. So XLV starting to underperform again. This is one of the sectors that if you're looking for shorts, or if you feel that markets are going to start pulling back a little bit, or whether it's over the next couple of weeks, next couple of months, these are the types of sectors that you want to search for. Short opportunities are these weak sectors like utilities and healthcare. So that's what we're currently starting to see, is a bit of rotation here within the equity markets. So taking a look at some of the economics, when we look at housing data, housing has predominantly been one of the strongest themes, if you will, of the recovery, as millions of workers shift from working in an office to working from home, moving away from urban areas to more suburban areas. There's been a huge amount of home buying, home sales, furniture buying, all of these things, everything related to home construction and home building has been a net beneficiary of this pandemic. So what we started to look at is the slowdown. We're starting to see a bit of a deceleration here in terms of pending home sales. We're seeing it in in closings and in pending home sales. These are both segments of the market that is still growing, but starting to decelerate. And we're seeing the same thing here from manufacturing as well. Manufacturing has actually been surprisingly strong off the recovery. This is partially due to pent-up demand and when they were shut down during the early stages of the pandemic, there was a lot of pent-up demand that caused manufacturing to rally very quickly or return back to normal very quickly. And there was also a lot of demand for consumer goods, certainly a shift in consumer goods as people stopped traveling, stopped going out to restaurants, people were buying consumer goods, and that drove this manufacturing boom. But we're also starting to see that slow down a little as well here. Still in expansion territory, but decelerating. And we're seeing this kind of across the board from economic indicators, whether we're looking at employment data, manufacturing data, housing data. So whenever we look at what has been driving a lot of the recovery here, we're starting to see deceleration here. And this is the challenge that I see for 2021. There's a lot of optimism for 2021 with COVID cases, with vaccine and what that can potentially do with COVID. A lot of people are talking about, getting back on a plane in 2021, getting back to normal or the new normal, if you will, in 2021. From my perspective, I think 2021 is going to be quite a bit challenging and a lot rockier than we might expect, simply because I think both equity markets and fixed income markets have kind of priced this vaccine to perfection, that we would instantly get this out to as many people as possible and people would just naturally feel comfortable getting back out there. And I just simply don't think that the road to recovery is that smooth, if you will. Now, the one thing that we currently continue to concern us is the number of rising COVID cases. Now, the only issue is that the holidays have stopped reporting on some of the some states have stopped recording over the holidays. So we saw this temporary dip here, but in reality, it's actually still continuing to rise here. Our expectation is likely going to continue to rise for at least another 1 to 2 weeks before we start to see this recover here. The hospitalization rates also continue to rise, but it is decelerating, which again is strong. But the one thing that I really want to point out here is the result of all of this continues to push the inequality, if you will, in this particular country. Prior to the pandemic, the number of unemployed for someone without a high school diploma was a little over 5%. It was about 2% for citizens with a bachelor degree. So the spread was about 3% or so. But since the pandemic, or since now, we're seeing a spread that has widened. The number of unemployed for someone with a bachelor degree is about 4%. Someone with a high school degree is about 10%. So now the spread has widened from about 3% to about 6%. This, in the short run, the headline numbers in terms of employment look particularly strong, but if we look at the actual numbers underneath it, this is speaking to a much lesser recovery than the headline numbers are pointing to. This is going to have ramifications in the long run. In terms of the shape of the recovery. This is something that I encourage investors to pay more attention to as you're investing in markets, because this lopsided inequality is going to cause some problems for the shape of the recovery, as well as, especially in the sectors of consumer goods and financials, and it is certainly one that I would pay attention to. So when we look at the ideas, I wanted to cover a few things first. Number one, we get a lot of questions regarding Tesla and the addition to the S&P 500. Largely, that's the news that drove this recent breakout here from its all-time high. So we had an all-time high of about $500 level. We had a triangle that had traded within between these two levels, and on the news of the S&P 500 addition, there's been a lot of buying of this particular stock. A lot of investors are saying, there needs to be purchases of about, anywhere from 100 to 150 million shares of Tesla, depending on where we are on December 21st. When it actually is added to the S&P 500 index, you have a lot of passive and active managers that are, passive money managers that are going to have to purchase a Tesla stock. Many of them already own a lot of Tesla stock. They have to buy even more Tesla stock to make sure that their portfolios, so for example, if you own SPY, currently the SPY portfolio does not own Tesla, and they're going to have to buy a lot of Tesla, and they're going to have to do it all on one day, December 21st, in order for them to start tracking this index. So a lot of them are going to start buying on the Friday prior to that. So a lot of investors are basically saying, let me buy ahead of that, and we're seeing that right now here over the past couple of days, and that's really what's drove this stock from 500 to 600 over the last week or so. Now, what is our expectation on December 21st? From my perspective, a lot of volatility. It's likely going to end up where on that day markets, Tesla will likely end up higher than where it starts the day. But largely, index additions are not big moves for a stock. But generally speaking, indexes do not add stocks that are this big to a passive index. Usually, they get added much earlier. If you look at Apple, Apple joined the S&P 500 in 1982. We've never seen companies rise to these types of market caps in such short amounts of time. And that's really what's driving a lot of distortions here that we're seeing here in Tesla. Another question that we've been getting here is Slack being taken over by Salesforce and what to do here. Now, here's the thing, is that the move here in Slack from about $30 to $43 is purely speculative on the fact that the news was announced, but there's been no confirmation in terms of whether the deal is done, and the deal is not done, to be clear. And the price at which the deal will be done is also unclear, and what premium Salesforce will pay for Slack Technologies. If they end up paying, let's say, $38 a share, then the stock will basically, get back to $38 a share. If they pay $50 a share, then the stock will rally to $50 a share. The question is, we don't know what the acquisition price will be. Investors have already responded by buying a lot of this Slack stock. Now, again, this deal is not confirmed. So next week, if we hear that this deal didn't go through, the stock will likely plummet back down to $30. So, that's really what to expect here over the next week. If there is type of announcement, is really just, if there is a deal, they'll announce the price at which the stock will basically instantly reprice to that particular price. Or if the deal's not done, the stock will likely return back to its $30 level prior to the news announcement. So when we look at our ideas, before I talked about XLF, we talked about the move higher we're starting to see in the 10-year yield, or the continuation of the move higher here in the 10-year yield. From my perspective, to play that upside, it's better from my perspective to play using KRE, which has a pretty high correlation to the US 10-year, certainly higher than XLF. Big pullback here over the past couple of days, and I think that is your opportunity if you missed out on the initial move here on KRE to look for a long opportunity continuing higher here using financials, or regional banks rather, which are more sensitive to these yields or have a higher correlation to these yields than if you look at a broad-based index like KRE. Another one I want to pay attention to are the airlines. Right now, I'm by far my favorite airline here is LUV, Southwest Airlines. But the one thing I want to point out here is that, playing this recovery here is a bit like playing leverage here. And if you look at all of the major airlines, American Airlines is the most levered, which means that if you do get a recovery, you're going to see likely better performance from American Airlines than you might see from Southwest, which has far less debt, has a lot more cash on their balance books, on their balance sheet. American Airlines, far more debt, far less cash. So if you do see an upside move here in airlines due to the vaccine news or optimism on the distribution of the vaccine, you're likely going to see a bigger move from these airlines that are heavily levered like American Airlines. So if you're looking for that pop or that opportunity, I think American Airlines, the fact that it's pulling back to its 200-day moving average is also a potential opportunity from a risk to reward ratio to seek some long exposure. Now, we get a lot of questions on electrical vehicles, and I think there was a few more in this particular chat. And, when you look at the electrical vehicle space, as much as you would like the story of NIO and some of the other Chinese electrical vehicles or Tesla, they are, for all intents and purposes, trading at valuations that are just absolutely insane for the revenue that they are generating. I think a lot of people are thinking long term, right? People buying NIO thinking at least 5 to 10 years out. And if that is your time horizon, by all means, I think that, picking up these stocks at these levels, thinking that long term is you can do it, paying those types of valuations. But if you're a short-term trader, those valuations simply just mean a lot of volatility. So if you're looking for more, a little bit more calmer in terms of electrical vehicles, one thing that I will point out, and this is a company that I've been talking about for quite some time, is really GM. GM has the same focus on electrical vehicles. Out of the major car manufacturers. GM has by far the largest electric vehicle portfolio coming out over the next few years, and they're focused more on the higher margin vehicles, which I think positions them fairly well within the broader broader car manufacturers. And they've really restructured here over the past couple of years. They're a much smaller company. They're more nimble, certainly not like NIO by any means, but more nimble than any of the other major three car manufacturers. So if you're looking for an electrical vehicle play for the long run that's not trading at crazy valuations, GM is certainly one that I would pay attention to. So with that covers what I wanted to share with you here today. I hope that this was helpful in giving you a better understanding as to where the current market sits, what opportunities we are currently looking at, and how we're playing the different reopening trades, if you will, in the current markets. Now, I only have a couple of minutes here. I'll try to answer a few questions here. Marjorie is saying an economist has predicted a wave of bankruptcies. Is this also a threat in your opinion? Marjorie, yes, it is certainly a threat, but I think you have to think about where are those bankruptcies going to materialize? What sector do you think they're going to materialize? I think different investors have different views on this front, and we also said that we were going to see a wave of bankruptcies by now. We haven't seen it largely because of the Fed stepping in and providing liquidity in the secondary and primary markets here. So broader based companies have access to liquidity that they simply didn't have prior to the pandemic. And that is really what staved off a lot of these bankruptcies. Largely we're going to likely see them in the small caps more so than anywhere else. Can we buy Bitcoin on Firstrade? No, you cannot buy Bitcoin on Firstrade. I believe in 2021 we will continue to have elections impact. Sure, absolutely. The election is definitely going to influence how markets react in 2021, or specifically sectors rather than the market per se. I would say largely the market is agnostic to who is the president. What's your view on gold? Gold continues to decline here. Our expectation is gold for a potential continuation lower here, but I will say gold is quite oversold here. You will likely, in my opinion, see a bit of a bounce here in gold, but long term, I think gold continues to decline here to the downside. So with that, thank you so much. I hope that you guys find this useful in helping you start off your week. Like I said, a lot of potential movement here in the broader markets here over the next couple of days. So pay attention and best of luck with trading. Thank you so much. I hope you guys have a great day.